A speech before the speech, new Fed Governor Lisa Cook saying she anticipates ongoing increases in the target range. She says the search for a sufficiently restrictive rate, which she says the Fed needs to get to, is only going to be learned over time. So she doesn't seem to have a preordained notion of where that goes. She is mindful, however, that policy or these rate hikes operate with long lags, and saying as a result, it's prudent for the Fed to move in smaller steps than the Fed had been moving in. The Fed will keep at it, she says, until the job is done. Inflation remains much too high, though she has seen some improvement. She called the October inflation report, quote, encouraging, but she's still cautious, as that is not enough for the Fed to turn course on. Core goods inflation is slowing. That's good, but as other Fed officials have done, she's pointing to services inflation, said it's not yet slowed, or certainly not yet slowed enough, and it may prove to be more persistent and keep inflation or the overall levels elevated over time. And another area that she and other Fed members are looking at, wage growth, she says, remains above the level consistent with 2% inflation. This is largely a very interesting speech about productivity. She notes that productivity growth has been lackluster in recent years. It is a cause for concern. Some people have suggested that low productivity growth is a reason for a higher funds rate because it's a more potentially inflationary environment. She did note, as we've been talking about, Scott, consumer spending remains resilient. And now, I guess it's just about 43 minutes until the big speech of the day, Fed Chair Jay Powell. Scott?
So I got a few things for you playing off of these comments. She says that the consumer remains strong, okay? I just had the CEO of Andy Jassy at the beginning of this program suggest that the consumer isn't remaining strong, that the consumer is being more careful, that the consumer is trading down. And for a variety of reasons that many companies are now going through, they need to become, in his words, quote, more slim. She also says we're going to keep at it until the job is done. Well, how are they going to know that they're not breaking something while they're still doing the job until they figure or decide, at whatever degree they decide that they've gotten to, that it's done?
Her answer to the second question is that's why they're going to go in smaller increments, Scott, and they're going to have to get a feel for where that sufficiently restrictive rate is. It is not science, Scott. It is art, or maybe that's overstating how nice this is. It's not necessarily art. Maybe it's graffiti is a better way to put it. And it's very hard for the Fed to know that. And in the past, as you know, they've gone further than they needed to go. I do think there is a growing minority on the Fed that's a little more outspoken about concern about lags about the economy. You saw that language come into the statement last time around. So perhaps there is a slowing coming. There's definitely a slowing coming, and maybe early next year. I still think, Scott, they're going to get to that 5% range using their models that suggest they need to be at least there. On the consumer, Scott, what I'm hearing is very sort of bespoke to each company. I've heard some companies say consumers fine, consumers doing well, and then you look at those retail sales reports we had, look at the GDP report from the third quarter, the consumer continues to spend above and beyond the inflation rate that's out there. That's what the data say. I would just be a little careful about one company's anecdote being overall evidence.
Well, I mean, Steve, this is Amazon, right? Right? This is not, mom and pop shop.
Didn't they just say they had their best Black Friday ever?
Yeah, the consumer is spending, right? The consumer, of course, is
case closed, right?
Buoyed by the fact that they've had all this money and they have credit cards. No, it's not case closed. It's what lies ahead. It's that the Fed doesn't appreciate enough about how things are changing and maybe how much more quickly they're changing, and that they're going to overdo it. It goes to the Kolanovic note from the top of our show, Steve. We believe that further market and economic weakness may occur as a result of central bank over-tightening. This is somebody who tried to give the Fed the benefit of the doubt and now doesn't seem to be able to do that anymore.
Yeah, but did you see what happened, Scott, with autos? Autos are up to 15 million units. Cars are still moving off the shelves, not the shelves, off the lots. You still have housing at 1.4 million annual units for new construction. I'm having a hard time.